Hello and welcome to Curious Soul, the channel where we break down complex topics into simple and clear explanations. In this video, we are going to talk about the SVB crisis, one of the biggest bank failures in recent history that has shaken up the global financial system. What is SVB? How did it collapse? And what are the implications for the world economy? Let's find out. SVB stands for Silicon Valley Bank, a lender based in California that specialized in serving U.S. technology startups. Founded in 1983, SVB grew rapidly over the years by providing loans, deposits, and other banking services to thousands of tech companies, including some of the biggest names like Airbnb, Uber, and Stripe. By 2022, SVB had more than $200 billion in assets and was ranked among the top 50 banks in the U.S. But things took a dramatic turn for SVB on March 10, 2023, when U.S. regulators seized its assets after a massive run on deposits by its customers. Within 48 hours, SVB had lost more than $50 billion of its deposits, wiping out its capital and triggering its collapse. This was the largest bank failure in the U.S. since 2008. So what caused this sudden downfall of SVB? Well, it all started with a change in interest rates. As you may know, interest rates are set by central banks like the Federal Reserve to influence borrowing and spending in the economy. When interest rates are low, borrowing is cheap and spending is high. When interest rates are high, borrowing is expensive and spending is low. During the COVID-19 pandemic, interest rates were kept very low by central banks around the world to stimulate economic recovery. This created a favorable environment for tech companies that thrived on providing online services to people stuck at home. As a result, many tech companies saw their revenues soar and their cash balances pile up. SVB was one of the main beneficiaries of this tech boom as it received huge inflows of deposits from its tech clients. But instead of lending out these deposits to other businesses or individuals who needed credit, which is what most banks do, SVB invested most of them into U.S. government bonds, also known as treasuries. Treasuries are considered one of the safest types of investment because they are backed by the full faith and credit of the U.S. government. This means that the U.S. government promises to pay back the bondholders on time and in full, no matter what. However, there is a catch. Treasuries have different maturities, or durations, ranging from a few weeks to 30 years. And their prices move inversely with interest rates. This means that when interest rates go up, treasury prices go down. And when interest rates go down, treasury prices go up. This is exactly what happened to SVB's treasuries portfolio during the pandemic. As interest rates were very low due to the Fed's stimulus measures, SVB bought long-term treasuries with high interest rates using its short-term deposits, such as overnight funds at near zero. This created a positive spread between its assets and liabilities, meaning that SVB earned more money from its investments than it paid out to its depositors. However, this strategy backfired when the Fed started raising interest rates in 2022 to combat rising inflation. Inflation is a general increase in the prices of goods and services over time, which reduces the purchasing power of money. Inflation can be caused by many factors, such as excess demand, supply shocks, money printing, or expectations. In 2022, inflation in the U.S. reached its highest level since 1981, averaging 6.8% for the year. This was mainly due to supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. The Fed responded by hiking its benchmark interest rate 7 times throughout the year, from near zero at the start of 2022 to 4.25% by December. As a result, treasury prices fell sharply as investors demanded higher yields to lend to the U.S. government. For example, the yield on the 10-year Treasury bond rose from around 1% in January 2022 to around 4% by December 2022. This means that SVB's Treasuries portfolio lost a lot of value as interest rates rose. At the same time, SVB's tech clients started to face a slowdown in their businesses as consumer demand weakened and competition intensified. Many tech companies saw their revenues decline, their profits shrink, and their stock prices plummet. Some even went bankrupt or were acquired by larger rivals. This meant that SVB's deposit base became less stable and more volatile as its tech clients withdrew their funds to cover their expenses or pay off their debts. SVB also faced higher credit risk as some of its borrowers defaulted on their loans or asked for forbearance. To make matters worse, SVB faced a bank run on its deposits by its customers who panicked after hearing about its losses and liquidity problems. A bank run is a situation where many depositors withdraw their money at the same time, fearing that the bank might fail or run out of cash. This can create a self-fulfilling prophecy, as the bank may indeed run out of cash if it cannot meet all the withdrawal requests. According to some reports, SVB lost more than $50 billion of its deposits within 48 hours, as some of its biggest clients such as Founders Fund, Coacha Management and Union Square Ventures instructed their portfolio companies to pull their funds from the bank. This was more than SVB could handle, as it had only $15 billion in cash and equivalents at the end of 2022. Unable to raise enough capital or find a buyer in time, SVB was seized by California banking regulators on March 10, who appointed the Federal Deposit Insurance Corporation as its receiver. The FDIC is a government agency that insures deposits up to $250,000 per account, in case of bank failures. The FDIC created a new bank called Deposit Insurance National Bank of Santa Clara to hold SVB's assets and ensure that insured depositors have access to their money starting March 13. However, many of SVB's depositors were uninsured, meaning that they had more than $250,000 in their accounts and were not covered by the FDIC's guarantee. According to some estimates, about 97% of SVB's deposits by value were uninsured, amounting to more than $170 billion. This created a huge uncertainty and anxiety for many tech companies and investors who had their funds in SVB. Some of them feared losing their money or being unable to access it for a long time. Some also worried about the impact on their cash flow, operations, and growth plans. However, the U.S. government intervened to protect all SVB depositors, both insured and uninsured, by invoking a rare exception called the Systematic Risk Exemption. The SRE allows the Treasury Secretary to authorize the FDIC to use its funds to cover uninsured deposits if there is a systemic risk to the financial system or the economy. The Treasury Secretary, Janet Yellen, made this decision after consulting with President Biden and getting recommendations from the boards of the FDIC and the Federal Reserve. The FDIC said that it will recover any losses from its funds by charging a special assessment on other banks, so that taxpayers will not bear any costs. The Federal Reserve also created a new lending program called Bank Term Funding Program, BTFP, to provide liquidity to other banks that may face withdrawal pressures due to SVB's collapse. The BTFP will offer loans up to 1 year long to banks that pledge certain assets as collateral. These actions were meant to reduce stress across the financial system, support financial stability, and minimize any impact on businesses, households, and the broader economy. The hope is that this rapid response will stop any further panic that could drive more bank runs or contagion effects. However, some questions remain unanswered. What will happen to SVB's assets and liabilities? Will the FDIC find a buyer for SVB or liquidate it? How will SVB's shareholders and creditors be affected? How will SVB's failure affect the tech sector and its innovation potential? And what are the lessons learned from this crisis for regulators, banks, and depositors? We will explore these questions in our next video. Until then, thank you for watching Curious Soul. If you enjoyed this video, please like, share, and subscribe to our channel. And don't forget to hit the bell icon to get notified of our latest uploads. See you next time.